Hey guys, thanks for dropping in again. This is Stock Muscle. I'm your host, Ty. I got a quick scenario for you before we get started. Let's say you're a business owner and you own a popular burger joint. Your burger joint brings in $1 million in revenue per year. You also have about $250,000 in cash from operations from the business. I'm an investor. I'm Warren Buffett, and I come to you and say, hey, I'd like to buy the entire business for, let's say, $500,000. Would you sell me the business? I didn't think so. I got a company that I think presents a very similar situation. I'm actually buying the shares, or I've been buying the shares, and I probably will continue to if the stock goes down. Let's talk about the company. Okay, so the name of the company that I'd like to talk to you about today is a company that some of you may or may not know. The company name is Academy Sports and Outdoors. The current ticker symbol is ASO. So when you look it up on Yahoo Finance or Market Watch or whatever it is that you use, the ticker symbol is ASO. This is a sporting goods and outdoor retailer. So they sell everything from, Nike T-shirts to grills to guns and ammo, which is a very popular product at this point. From what I've been hearing, ammo and bullets are pretty much almost always sold out. So they do guns and ammo as well, and they're once again a sporting and outdoor goods retailer. The company closed today at $37.06 per share. I think the stock could go to $60. So I think the stock could nearly double. And let's get into why. So the first thing I want to pull up is a snapshot from Yahoo Finance. So let's take a look at it. What I want you to pay attention to in this snapshot is the market cap of the company. So for those who don't know, the market cap is the total value of the company. So if I wanted to buy the company out, I would essentially have to pay the market cap, and that's the value of all of the outstanding shares. So it's about $3.3 billion. If I pay that, I own the entire company. So that's where the company's trading at right now. That's its valuation. That's number one. Second thing I want to look at is let's look at the company's income statement. So we want to look at first we want to look at the kind of revenue that the company's bringing in. So I highlighted 3 columns for you guys. The first one is going to be the company's operating revenue. Now, if we look at revenue from 2018 to 2021, we're probably not too impressed. Revenue has been relatively stagnant with the exception of 2021. The company's getting a good COVID push. So what's been happening with the sports and outdoors companies is they've been really killing it. Dick's Sporting Goods, Big Five Sporting Goods have all been reporting excellent numbers because people have been locked in the house. People have been buying things like tents and fishing poles and things that encourage outdoor activities. So these companies have really been killing it with those products and goods. So you're seeing a bit of a COVID push, but for the most part, revenue has been a bit stagnant. That's a little bit of a negative for me, but that's not the play here. If we scroll down to the second highlighted column, that's going to be your net income. Like I told you guys in my first video, it's not always about the revenue. It's about how much you're keeping. So we can see that net income is growing for the company. That probably means that their profit margins are improving for some reason. I'm guessing that typically when you see profit margins increasing with a company like this, they've probably invested in some private label brands. For example, Target has their Goodfellow brand, and that's high margin stuff. They own it. They can sell it for more. It costs them less to produce. So the company is getting better at keeping more money. For whatever reason that is, we'll dig into that later. But net income is going up. Third thing, the bottom highlighted column is earnings per share. The company's earnings are going up. So in 2018, they only earned about 70 cents per share. That's elevated to almost $4 per share. That's a very bullish signal. So as far as income goes, the company's doing okay. I like to see revenue ticking up, but that's not the play here. The next thing we want to take a quick look at is the balance sheet. The balance sheet is a test of solvency. If Academy Sports and Outdoors got in trouble for some reason, let's say a pandemic hit, like what just happened last year, and they needed to satisfy all of their bills, would they be able to do it? So what we want to look at is the assets versus liabilities. Looking at the assets column, which is the top highlighted column, they have about $4 billion in assets. they have about $3 billion in liabilities. Liabilities are the things that take away from the company or the things that are owed by the company. So if Academy Sports got in trouble, they have enough assets to cover their liabilities, which is a positive. I believe that it's either Warren Buffett or Peter Lynch believes that, or maybe it was Ben Graham who said that he liked to see assets at least double liabilities. Maybe it was Joel Greenblatt as well. It was one of the big guys. But they look for assets to double liabilities. I'm not a stickler like that. I just want to know that if the company gets in trouble, they could satisfy all of their liabilities and still survive. It looks like ASO could do that. Assets exceed liabilities. The last thing that I want to look at is the cash position. I'm a big fan of companies that have the ability to generate cash. I feel like if your net income's good, your revenue is good, that should be trickling down to cash from operations, and that's a net positive. Currently, the company's sitting on $1 billion in cash. So let's go back to the question that I asked you before we started the video. You own your burger joint. It's worth $1 million. You're also sitting in $250,000 in cash. You wouldn't sell that business for $500,000. It's the same thing with ASO, and this is why I think the company is trading too cheaply. If we jot back over to the Yahoo chart, let me remind you that you can go into the open market and buy the entire business right now for $3.3 billion. The company expects that this year they'll do $6 billion in revenue. So right now I could buy this company for half of its revenue, about half its revenue. That's too cheap for me. Now, when you also add in the fact that the company has $1 billion in cash, so if I were to buy the entire company, I would also inherit that $1 billion in cash. That would essentially means that I could buy ASO for $2 billion on the open market. Let's be more specific, about $2.3 billion on the open market. I think that's far too cheap. If you guys disagree, let me know in the comments if I'm crazy, if there's something that I'm missing here. But I like to see scenarios like this. This, in my opinion, is somewhat of a value play. I think that the market needs to award this company with a higher valuation. What you typically see with the sports and outdoor companies. So let's talk about Dick's Sporting Goods, which is the biggest player. Let's talk about Hibbett, which I think is about 3 or 4. Dick's Sporting Goods, you can buy it on the open market for about $9 billion, and they do about $9 billion in revenue. So I could buy Dick's Sporting Goods at revenue. Hibbett does about $1 billion in revenue. I could buy the company for about $1 billion in revenue. So I could buy Hibbett Sports at revenue. So why is it that I can buy Academy Sports and Outdoor on the open market right now for half its revenue? What is it about ASO that they're not doing or executing on? The profit margins for the sector are pretty similar. They all do about 5 to 10%, so there's nothing there. I just generally think that the company's far too cheap. And that's why I made about a $10,000 investment in the company, and I'm probably going to be buying the company if it gets any cheaper, because if the price comes down, that means that price per share comes down. That means the market cap's coming down, and that's exacerbating this situation. That's most of the thesis for my investment in Academy Sports and Outdoors. Other than the fact that I do frequent the shop sometimes. I remember when I couldn't find weights. And this was during the pandemic, and Academy was one of the only places that had 5 and 10 pound free weights. So I am a customer there. But that's most of my thesis for the company. And let's do a quick recap. So the company is very strong financially. Management came out and said that they expect to do over $6 billion in revenue this year. Their net income has grown over the last 4 years, and they're over $200 million in net revenue at this point, and they're sitting on $1 billion in cash. That's over 30% of the entire value of the company they're sitting on in cash currently. Very strong position. And what could they do with the cash? You guys are smart. What do companies do with strong cash positions? So you could either declare a share buyback program. You could start buying in shares to improve shareholder value. So if the company starts to retire shares, that means the shares that you own are worth more. That's always positive. They could strengthen their balance sheet by paying off debt. And I actually believe that they started to do this. I think they paid $100 million and some of their notes off, and I think it was to the tune of $100 million. So they're actually doing that now. You could remodel your stores. They may be doing some of that right now. You could do a lot of positives to enhance the company with $1 billion. But I won't bore you guys with any more of the details. Like I said, hit the like button if you like the content. Don't forget to hit the subscribe button as well. And leave a message in the comments if you think I'm absolutely loony and missing something on this deal. But like I said, I've already made a $10,000 investment in the company. My price target is $60 per share. I'll consider selling once it gets above $50, but I think this stock could easily get to about $60 per share, which would value the entire company at about $6+ billion, which is going to be at revenue. Remember, we said that we can buy all of the competitors like Dick's Sporting Goods. We can buy them at revenue. And I think the market needs to further appreciate ASO. And I'll be looking to sell the company when I think it's fairly valued, which in my book would be at revenue. Once again, guys, I'm your host, Ty. This is Stock Muscle. Drop me a message in the comments if you disagree or agree. Either way, hit the like button, hit the subscribe button. Talk to you guys later.